This is episode 240 of the Andrew Hines Real Estate Investing Podcast. This episode is brought to you by Control and Compound Financial. They teach real estate investors how to multiply their wealth using infinite banking strategies. For a complimentary wealth coaching session or to learn more, visit www.controlandcompound.com/Andrew Hines. Welcome back to the show. Today I have Cody Yeh on, and Cody was on the show back before episode 100. I think it was right around episode 96 or something like that. And this was like the end of 2020. Back then, people were getting very interested in options trading, so that was a very popular thing. And then for the past few years, we haven't really heard a whole lot about that, and primarily I think that's because a lot of people had a bit of a rough go, specifically in the last year and a half, where they ended up potentially making some moves and it cost them some money. So I find that's pretty common. People don't like to talk about their losses, so things just go quiet. So it was interesting to me that Cody's still doing that. In this episode, we talked about that. Of course, we also talked about his primary residence, and then a common issue with Airbnbs and the whole HST treatment. So this is a constant thing that people have been worried about, especially with the arbitrage situation. Less common now, since arbitrage is not nearly as common here in Canada because the numbers don't really work, or the municipalities don't really allow it to work. I guess more the latter. The municipalities really aren't allowing it. But it was an interesting conversation nonetheless. Lots of gold nuggets from Cody. He's a high performer, business-minded guy, success-minded guy, and he's building an organization. He's an entrepreneur, and I like having that type on this show because real estate investors are entrepreneurs, and as we scale, we sort of take it to that next level. Of course, there's some people who just want to buy a rental property, but then we've got those that want to go big, and we've got something for everybody here. So please enjoy that. Just before we jump in, if you could kindly do all those things that help get this podcast out there, share it with a friend, like, subscribe. Reviews are great. If you can leave a 5-star review, if you haven't already done that, please just take a moment to do that. It really helps get the word out there. And then, like I said, of course, you sharing it with somebody you think would enjoy it is another great thing. I find that this podcast primarily grows by people just telling their friends about it. So please don't hesitate to do so. And a reminder that we host the monthly GTA West REI meetup at West Ave Cider. Please make sure you're in our private group so that you can get notified about the next event, which will be happening in September. Now, without further ado, let's jump into the episode with Cody Yeh. Hello and welcome to the Andrew Hines Real Estate Investing Podcast. I've got Cody Yeh back on the show. It's been, a long time, like 140 epipisodes ago, something like that.
It's about 2-3 years ago, yeah.
Yes, because I think you were like episode 96 or somewhere around that.
Yeah.
If I'm not mistaken.
December 2020, I think.
Really? Yeah. So a long time. So a while. We do about 50 episodes a year. So we're looking at about 3 years ago. I don't know what you've been up to. We saw each other just recently at my golf event, and you're back for the catch up. So thanks for doing this.
Yeah. Thanks for having me. So the last 3 years, definitely really interesting. We only bought one real estate. Well, we were trying to buy some stuff down in U.S., like the Cape Coral.
Yeah, we were talking about Cape Coral. I know you had put an offer in on something. We were just talking about something interesting before this, which we'll get into. What else did you get into?
So yeah, that was, we were actually, my money was down there, put in deposit, but the seller just won't budge. We think they overpriced. So we pull it back. Yeah. And I think since then, the listing dropped like $300K in 1 year.
Is it still listed?
I didn't check, but there's similar houses in the neighbor are still listed.
So you're looking at Naples Park, which anyone who's been to Naples is really, it's a really nice place. And Naples Park is like that area that you can do Airbnb unrestricted because there's no HOA. So I know many people who are invested in Naples Park.
Yeah, there's like Jacob Perez and all that. They all have something in there.
Yeah. Matt Piche's got that.
Matt Piche, yeah.
Another buddy of mine, Francesco Peretta, he's been on the show. Yeah. And there's, I'm sure there's many more I don't know about.
Yeah. So that kind of took on a pause, and I'm like, okay. Then we're looking at, because the whole garden suite was an interesting thing. And, at first, Claudette, my fiance, well, back then was a girlfriend. Then we got engaged last year.
Congrats.
Thank you. And that was a year ago. And we're thinking, okay, if we're ever going to have kids, we should probably have a home. And we're like, you know what? It will be a good chance to build one. So we bought right at the hype before the interest rate drop. And right at, I think, what was that? March 2021. We closed on March 14. A big lot, like 53 by 220, and like Bowmanville, for people who doesn't know, that's east of Oshawa, a 15-minute drive. And we bought that land and turned the house up front to a legal duplex, and we started building a house in the back. And it cost some money, but the idea was that we could eventually move in or would move in. And
which house would you move into?
Oh, of course, the house in the back.
The house in the back.
Yeah.
And that one's the one we were talking about? It's on Airbnb now?
Yeah, that one's the one we're talking about that's on Airbnb. Like we kind of have to, at first we're like very excited, make it really nice. Like, this is the way we're going to do it if we move in. 2-bedroom up, 2-bedroom down, 11 feet ceiling, main floor, 10 feet in the basement.
There was no zoning restrictions to say that your garden suite couldn't be like monstrous? Or did you just have a really big lot?
So for people who are listening to this, I believe I was the first one to build a so-called additional dwelling unit. They don't even call it garden suite. And the city was very flexible. Yeah. Because when we submitted our drawing, the city actually told us that, hey, you can go even higher. I thought the maximum height was 5.25 meter. We thought it was to the lower end of the roof. They were like, no, it's right to the middle of the pitch. Like, okay, well, we have a few 4 feet. Okay, let's build it up even more. So there wasn't, right? So
because there's municipalities that say like you can only go 10% of the existing footprint of the house, like basically a shed. Yeah, which is not going to work. But I mean, every municipality sort of does it a little different, I guess. And this is what I found as well, as you go with those smaller municipalities who just haven't seen a lot and they're less organized. Yeah, they're more like, oh yeah, we could work with you on something like that.
Yeah, and I make sure that I hire local people. So I think, like, it's funny. First day we closed on the house, our contractor came in with 6 jackhammer in the basement, and we were like digging some stuff because there was an unlevel concrete. They call on OPP, and because OPP came and they're like, where do you live? They're like, oh, I'm right down next block. Like, okay, fine. They walk away. But if it's some contractor from Toronto, I think they would be really strict on it, right? And that was the thing. And then the drafter was local. All my contractors were local, so that was a lot easier to work with. The neighbors were a lot happier. Yeah. And we make sure we work with them. We have fence coming up, right? 7 feet fence, like not just chain link. We took down the chain link, put out the fence. Yeah. Just to make sure we all keep as much privacy as possible, and then we don't bother them and all that. So there's a lot of interesting things that go into it, and yeah, now it's
how big's the lot?
53 by 220.
53 by 220. So a good sized lot. Is it in town?
It's right in town. It's 5 minutes walk from the hospital, from the Bowmanville Hospital.
So how will your parking situation work for the rear house?
Good question. So at first we have a house up front, and there was a garage attached to it, kind of thing, kind of like that. Okay. And then we took the garage down.
Yeah, so you could drive through, right?
Drive through it, and then our parking lot is in the middle. So we have,
so people can park behind the house.
Yeah, behind the front house. We have 5 parallel parking. Yeah. We can literally park, if we really scram it, maybe like 12 to 16 cars if we really want. Yeah. In the middle. We just have to watch out the storm water, because that was what city was worried about. So we have to like pull it back a little bit, give enough green space. But we have like 4 tenant parking for the front house, and we have a front parking pad as well. We check with the city. They're like, yeah, it's yours. Do whatever you want. Unless
some municipalities won't let you have parking.
I know Hamilton doesn't let you, right? Yeah, unless it's less than 50%. I'm like, send me an email. Send me an email.
Yeah, you got to get that in writing. Yeah.
Right. And then we get then we have 4 more parking for the back house. We can park up to 6 really. So
yeah. And how big is the back house?
It's 1 square feet smaller than the front house in terms of 2D.
Was that the restriction? It just had to be a little smaller than the front house?
It has to be smaller, so we loaded 1 square feet smaller.
So what's the total square footage like?
I think 950 maybe.
950 square feet. Yeah, and you can get 4 bedrooms into 950 square feet?
Yeah, 2 up, 2 down. So 2 up and 2 down.
Is it like a loft, like upstairs?
No, it's kind of like a bungalow. Right, you walk up into it, and it's like a bungalow, and then you have a basement, right?
So like would it be a 1.5 story then, or? Or you're saying the main, the down is the basement.
Down is the basement.
Okay. I thought you were saying like the main floor. Okay. My apologies. Yeah. So just a bungalow, nothing in the loft. It's just an attic.
Yeah.
You got tall ceilings though, and then you got a basement.
It looks kind of bigger than the front of the house, but in terms of square footage, we're smaller. 1 square.
So 950 square foot footprint, full usable basement.
Yes.
So almost 2,000 square feet of floor space.
Yes.
Yeah. That's workable.
That's workable. Yeah. It's we're killing it on Airbnb, and I brought up other income issue and all that. We got to sort it out.
Yeah. Are you good to talk about some of that on here?
Well, we're still on the figuring out phase. I talk about a lot of accountants. There's no conclusion on it, and then I think you told me some of your ideas on it.
Yeah. Well, there's an issue with in I would challenge people to go check with your accountants on this, because it's a CRA. Like, let's just lay it out there. So for an Airbnb that's a new build, like, people are assessing taxes. So say I wanted to take a property and sell it. The buyer is going to have a built-in piece of HST in that. If I go from ground up construction and I sell it, I got to register for HST, charge HST. Seller's going to pay it. It affects my sale price, because I'm going to have to net off 13%.
Yeah.
However, if I wanted to rent it, you might think, I can avoid the HST by not selling it. Well, no, CRA expects you to self-assess what you're worth, pay that HST, net of any HST you paid to build it. So if you paid the contractors all 13%, you'd be getting that back. But my argument, and I want people to check this with their accountants, because I'm not an accountant. This is just my logic. I've had many conversations. Like, say for instance, I was building a commercial storage facility or commercial retail. The end user is the customers that are being charged HST on the goods. So the tenants who rent the space pay HST, and then they charge their customers HST. So end users ultimately get charged, which is the idea, allegedly, of HST. So I wouldn't assess. That's my understanding, is that I would not assess that commercial space for HST. I would just build it, get all the HST I paid back. And, if I paid the Joe contractor, $1 million to build it, he got $130,000 in HST. So then I would apply to get that back from the government.
Yeah.
Not assess, but then I would go ahead and charge my tenants HST. So why would it be any different if you were doing it with an Airbnb? Like, if you're doing it
Where
with
are you charging HST on Airbnb?
Airbnb, you charge your guests HST if you're over the threshold, the $30,000 threshold. So this is the conversation Cody and I were having is, should he be entitled to be getting an amount of HST back for everything he paid to the contractors, and then the assessed amount on it. Yeah. So, which is something you're doing some research on.
I've been doing it for months, and we haven't even taken any money from Airbnb. We have like multiple 5 figures hold up on that, because you want to make sure when it's pay out, it's correctly pay out to the right account. The right thing. So we're holding back a lot of money on Airbnb side.
And I'm pretty sure like there's retroactive stuff you can do, which we were talking about off camera. Like, I'm pretty sure a good accountant can correct these situations, backdate them, because I went through an issue where I wanted to adjust my HST registration date, and they said, you just have to mail into the Timmins office with what your request is. So there is a way. Now, what that accomplishes, I'm no expert. Don't pretend to be. I think it's a valid and interesting discussion, and I think a lot of people are kind of concerned with Airbnb and the HST implication, maybe less so these days since every municipality is cracking down. But if you're using a house for exclusively HST, the whole reason I became aware of this, that for exclusively short-term rental, that's considered applicable for charging HST. So anything less than a month or 28 days.
28 days, yeah.
Yeah, so anything less than, or 28 days or less, would qualify that you have to charge the 13%. And one of the nasty little implications of that, which I've never heard an accountant say they had a full bulletproof solution for, was that if you're using it for commercial use, then when you go back to sell that house to somebody else, you would now need to charge HST to convert it back to residential.
That was the biggest thing. That was the biggest fear.
So
mine, yeah.
So for you, the position is more going to be, it was always commercial. And that would be me. If it were me, that would be how I would be approaching it. With, of course I would consult with the professionals and get their blessing. But because obviously you eventually you want that to be your home. But until then,
and that's the part where it makes it even more complicated. Is that
that layer.
We start honestly, like Claudia and I start honestly thinking about, if we ever have kids, are we going to live there? Because our in-laws is in Oakville, My mom is in Toronto. So are we going to live an hour or two away to get the amount of support we needed to? Is that realistic? Yeah, we have a lot of space, but if we're going to go out for lunch or dinner on Friday, is that realistic? So that's when we're thinking maybe we're never...
Maybe not ever, right?
Yeah, so...
And then maybe forever, like say that's one hypothetical direction you could go with it, is to just have it be a forever HST applicable use. So the government should theoretically be happy because they're getting quote unquote theirs for a very important reason. So they should technically be happy because you're charging it to the end user. You're going to be remitting the whole time for that. So these conversations, like, I do and I don't like getting into them because one, I think it's all BS at the end of the day. But if you're going to play the game, know what their expectations are.
Yeah. I just learned that you just pay enough to say that you pay it, and it's a lot easier if we come to that point we need to negotiate, right? But if you pay nothing and try to avoid it or whatever, it's just hard when it comes to that point.
Right. Like, so, but I mean, it would be typical course of business in construction that as you're building, like say you do quarterly remittance, which a lot of developers do. So, say they pay in a quarter, they're building 10 houses, they got a couple $1 million out, and of that 500,000 or whatever is HST. They want to get that back before waiting until next year.
Yeah.
So they file quarterly, they get these deposits back. So it helps them. It gives them cash to build with. Yeah. And that's all the HST they paid out to these contractors. And then it comes time, the house is done, they're going to sell it. Now they fork out and pay the amount when they get the sale. So it stops them from having so much out of pocket. So for you, it would be normal course of business for you to get a big deposit into your account, and then you start remitting to them, on a quarterly basis or a yearly or however you do it for what you collect.
Yeah,
that's just my understanding. Like, I unfortunately do deal with this stuff. Like with our camp, we remit, and I have a construction business, same deal. Like we're doing that stuff, and we're commercial use on our camp. So when we bought it, yes, HST was applicable, but we got it back right away. Mm-hmm. So when we bought the approximately $1.5 million camp, 13% HST is applicable. Oh, but we're an HST registrant, so that just cancels out, and you get it back. And then of course, people who stay at our camp pay HST. So I'm just applying the logic I know, and I put this out to the people listening on the podcast. Go talk to your accountant. Like, press them on this. If you're looking at doing a strategy where this is relevant, push them on it.
And then depending on your accountant, one accountant might not be specialized. So I actually pay money for HST specialists to give us a statement of it. And they, of course, tell you what the books stated. And which is like what transfer the HST. It's really looking at the end user, right? If you rent out to someone's the end user.
But did you express that this was your goal? Like, I know you were thinking about living it. You were the end user. But then it looks like in the interim, the interim, the plan's slightly different, right? So now it might be time for another conversation.
Yeah. So
a hypothetical. Let's do some hypotheticals here.
Yeah. So definitely consult with your accountant. Consult with a few. I check with like 4 or 5 already. So
that's the thing. And anyone who watches this will know. Like, I've had a few accountants on the show, and I pretty much asked them all this question, and I get a different, slightly different response. Yeah. And the one conclusive thing is that there's no bulletproof thing when it comes to the Airbnb side of things. If you are renting out an Airbnb house and it's not arm's length, like it's your company that's doing the leasing, like even if you do a year lease to your company, that's not arm's length. So they might still want to implicate you and say that that's commercial use of property and blah, blah, blah. Again, all nonsense. Like, let's just be completely upfront about that. But we're just talking, if you're going to play the game of Monopoly, you know the rules of Monopoly.
Yeah, let's just leave it there. I don't want to even get it more complicated. Say that it's my principal residence on exemption, but I'm not going to go there. I think that just like
this is an onion for Cody, but I just thought this is a relevant discussion, so I appreciate you humoring that discussion there. Yeah. But yeah, tell me like what that looks like, what you see as potential from an Airbnb standpoint. One, what did it cost to build this nice house you've created?
So the house in the back cost us about $500,000 all in. When I say $500,000, that includes asphalt for the whole driveway. That includes all the fencing. Yeah. And that includes the gazebo in the back. That includes everything down to the furniture. So that's I'll say $500,000.
So $500,000 all in, and obviously there's an additional tax amount that you have to pay. Like
that's all in with HST.
No. So I'm saying for property tax, they're going to reassess you if they haven't already.
I don't think they yet done that.
Yeah. So let's say they add $2,000 a year to your taxes. What's that increased your insurance by to insure that back house as well?
So the interesting thing is I checked this again, check a real insurance broker. Our front house and back house has a different insurance.
Completely separate insurance.
Yes. And
okay.
I thought I was so obscure, but I checked with both and they're okay with that.
Yeah, that makes sense.
And because the back house is more
it's
short-term rental.
Yeah.
The front house is with TD Melage, right? They don't want to touch any.
Yeah, they won't do any of that stuff.
So, and then our back house, I think is about, like 2,000 maybe.
2,000
per year, I think, for the insurance.
That makes sense.
Yeah, we got a really good quote referred by some of the big accounts that have short-term rental. So.
Yeah. Okay. And then utilities on that back. Is it well and septic?
No. It's
all city?
We have the whole city water like tee off.
Okay. Right, so you caught it. Do you have proper fall? Like you didn't
fall.
You didn't do a sewage ejector or anything like that?
No, we have a proper fall.
Yeah.
And back to
the street. Yeah.
The street.
Yeah.
And then electrical is separate, and gas. We have another gas line.
So you have separate gas, separate electric, a separate water meter as well?
Water meter, basically, water comes in and we have a flow meter at the main unit.
Oh, okay. So you just track it.
We just track it backwards, subtract.
Gotcha. Okay. So mostly separate utilities. That's a similar way I did my front back duplex when I added the rear unit. The only thing I didn't separate was the water because it was going to be like $30,000 to do.
Yeah. Which pulling a flow meter is $700.
Yeah. So. Did you have to dig into the street? Or did you guys connect inside your property line for the sewage?
So we caught that. That was a big thing why I had local contractors, because the city put a stamp on it without recognizing that they need to do some kind of study, height study and all that. So we were like, oh, you guys put a stamp on it. They're like, no, we need you to do this. So that was going to cost $50,000. So my contractor was really good. Talk with the city. We sat down and kind of negotiated. Hey, you missed that one, so I'm gonna do this. You're gonna give me a break here, right? Because you missed that one. You put a stamp on it. You can't come back to me and say you didn't talk to the water department. So we got a little bit break there. So that was kind of solved.
Yeah. Oh no, my stamp's already on it. Yeah. We'll have to make it work. Okay, that's all right. So you self-manage the Airbnb side of things?
Right now it's managed by Claudette, and Claudette is in the banking industry, and because I follow my entrepreneur journey and I bring her to a lot of short-term rental, to different events, she's inspired now to really have a second stream of income or eventually replace that and become an entrepreneur, just at least have the time and location freedom. Yeah. So she really enjoyed the Airbnb side because she's a branch manager at RBC, so she's already doing all that front end. And I was telling her, your mid-management experience of managing a team of people, it's going to be so crucial when you become an entrepreneur, because most likely you're going to manage this.
Yeah, you manage people,
So she was so amped up, and we're going to scale up on that side. Our goal, like, I'm not going to put the goal in her mouth, but my own goal is we're going to do this Airbnb scale up of Airbnb arbitrage and all that, not in Canada, most likely in US. We want to hit 7-figure in 1 year. I'm going to help her do that.
Beautiful.
Gross. Right. And then I'm going to help her build a team because I have like 3 to 4 teams already. So
let's go through the rest of these numbers here, because we'll talk potential rents, because I know you're seeing like what's possible, and that's great.
We're seeing real rents, and we know what the long-term rent is. We're getting about 2 times. So
we'll walk through the individual units. Let's starting at the front house. It's the duplex.
Legal duplex.
So you did the duplex yourself. Like
not myself,
you hired it.
You hired it. Hire.
Yeah. Okay. So you didn't buy it that way. So the top unit is how much a month?
$2,300, and they pay all the utility.
Okay. And then the bottom unit is
$1,800.
They all their own utilities.
Yeah, we basically charge them up front, and they're reconcile every quarter.
And then the rear unit, what would that do? Do you have an annual estimation of what it could do? I know you don't have a full year on that.
It's actually like, we don't have a pool, we don't have a hot tub, so it's actually very similar to the legal duplex.
Yeah.
The number is very similar.
Oh, so like the house as a whole.
Yeah.
So it'll do like $4,000 a month.
No, so if I rent out long term, it's about 3,000 to 3,500.
Yeah.
And then if you do a short term, and again, we only been started doing it since May.
Yeah.
And then summer and all that we've been doubling that.
So you've been getting like $8,000, or you can do $8,000?
Yeah, about 6. And then I heard a lot of people told me that Airbnb is a lot slower this year because I don't know if you get the same, because I know your in-law have a big Airbnb portfolio, but we just heard that's 30% lower.
Yeah, I've heard Airbnb is slower this year. Like we've ramped up at our camp, so like, yeah, it might be, but I mean, we've tripled it.
Yeah, it's good. Good for you.
Yeah. But we've expanded. So
yeah.
Okay, so you think, like, say you did put a hot tub in. Let's do a hypothetical. So say you put a hot tub in that house, the rear house, maybe a wood sauna or something outside, like some amenities, and dolled it up. Like, do you think you could average $8,000 a month on it?
Well, I couldn't say it because I haven't gone through.
Sample.
Like even right now, we're listing on MLS just to see if anyone want to rent it, fully furnished property for the slower season. We just take some risks off, right?
Yeah, and you see that the summer's just going to be busier in general.
Yeah, summer has been great. We book back to back. We have like 90% occupancy rate. Yeah, and that's first year. We hit our super hose in first month and all that. But just we're trying to take some risks off for the shoulder season.
Lucky you to get the super host the first month, and we had to do we just missed the cutoff for, like, it is quarterly, right? We just missed the first cutoff on it.
They said it's quarterly, but guess what? They review it a lot earlier than quarterly. Like we got it in the first month. We don't know somehow.
It just depends on when in the year you start.
Exactly.
Because did you hit their quarter, right? Because it's on their quarter, like on the calendar quarters.
Yeah. They cancel one of our reviews, and then we got more come in, and there's just in 7 days. Like Claudette was like heartbroken. Was like, oh, now we're gonna wait until October 1st, and then a week later, super host. Like, oh my.
Yeah, that was what we had to do. We had to wait until October 1st, so we got it. Like, we close our camp October 15th. So the first doesn't help that much. So let's just say you could hypothetically average $5,000 a month on Airbnb.
Yeah, I'll say
a hypothetical. Yeah. So then that's $9,000 across the whole property. Let's go through. So I was originally going to do this as just what that unit added, like looking at that in its own isolation. Maybe that's actually a better experiment.
Maybe that's a better experiment, I think.
Yeah. Let's just look at that in its own isolation. So we'll just say $5,000 a month rent, $60,000 a year. Your investment to get there was the $500,000. Did you refinance based on that or no?
Oh, yeah. We pull out $150K, not a lot.
So like that, it was a perfect BRRRR on that portion.
I wouldn't say a perfect BRRRR. We put in $500,000. We pull out $150,000.
Oh, so you didn't get 500 plus 150. No. You just got 150 back. Okay. Yeah. Hey, we'll come to that. So I just want to see how this is. So let's assume $2,000 more in taxes. So you spent the 500 to build, probably pay $2,000 more in taxes, $2,000 more in insurance for sure. We got a maintenance figure at $3,000 a year, which I think it's reasonable. Covers some basics if you have to paint or repairs or whatever. Mm-hmm. Utilities for that unit are probably going to be what, $3,500 a year.
I'll say reasonable.
Yeah. Okay, and then management, you're just doing it yourself. So I've got a 1%, works out to be $600 to just allow for management tools or what have you. Yeah. Landscaping and snow for that area.
Yeah, for grass cutting, we pay $75 bi-weekly. Mm-hmm. Snow plowing, I've been putting on my calendar. I haven't had a chance to find someone, but I think we'll probably, most likely, depending on how we rent it out, but we probably need the driveway shuffle whenever there's a big snow.
Yeah, you're probably going to be, I don't know, closer to $2,000 by the time you're all in.
$2,000 per year
for like including snow and your lawn, like $1,000 for the season for snow.
Yeah.
I mean, like it could be worse. It depends on if it's a bad, like it's all, what kind of contract do you get? Do you get a contract that's fixed, or do you get one that's just, hey, every time we come out, we'll charge you this?
Yeah.
So, I mean, if it was this past year, that would have been great. We barely had any snow.
Exactly.
Yeah. So it just depends on the year.
Yeah.
We got it all in the summer, just nothing but rain. Consumables for that house, like would $100 a month cover it?
Yeah. I'll say $100 per month. We just have some coffees, nice
coffees, toilet paper, paper towel, all that stuff.
I think it'll be Yeah.
I probably don't even spend $100 a month, maybe 70, 75.
It's fine. Put $100.
We'll
want to
leave
be
it
on a conservative side.
We'll leave it. Yeah. So, you know, we've done this on the show a couple of times, like look at, you know, what can actually get a good cap rate, like as an investment.
Yeah.
And your cap rate on that. So if it does $5,000 a month, $60,000 a year, with all those expenses we just went through, and then a miscellaneous for $500 for just whatever might come up, that's a 9.6% return. So if you invested in that cash, the 500 cash out of pocket, that's 9.6% cash on cash. And then you've got appreciation potential. Mortgage pay down is something that can be factored in this as well. You said you did just what, 150,000 on that?
Yeah, back.
Yeah.
So yeah, and then we bring down the interest rate to about, I think, 6.19.
Is it a 30-year AM on that?
I think it's 25.
25.
It's actually interesting. Yeah, because we're getting the funding today. So, you know, now for people that doesn't know, they used to give out check. Now it's all wire. So literally
dropping
today,
it
I think
in your
right now,
account?
if I log into my account, I actually see that.
Hi friends, I just wanted to take a moment away from the episode to tell you about my brand new structured coaching program. This is the first time I've ever offered a structured coaching program where we'll have regular meetings in addition to an intro call to go through what your goals are and help you get on a plan to achieve those goals within real estate. So if you've followed me for some time and you feel that I would be a fit for you to help you achieve your goals in real estate based on my skill set, based on the topics we cover on this show, I encourage you to head over to my website, andrew-hines.com/coaching, and fill out the questionnaire so that we can schedule a call and figure out if it's a fit for us to work together. Let's face it, most people could benefit from a second set of eyes and ears going over their strategies, different deals that they're looking at, and helping to springboard ideas back and forth. This is a program that's exactly for that. So if you're looking to build confidence in what you're doing in real estate investing and get very clear on what it is you're trying to accomplish, this might just be the program for you. Take a moment, fill out that questionnaire, and let's schedule a chat. So here's the cool thing, like that endeavor, yes, you do have a fairly large chunk of money into it, but you're getting like $3,000 a month cash flow on it.
Yeah.
I mean, like it's a hypothetical because you haven't done a full year yet. And you know how those numbers shake out. Also, you'll have some decisions to make, whether you continue going down that route or if you just do long-term rental, right? This is a hypothetical.
Or mid-term rental, whatever that is. Yeah.
Yeah.
But like, truthfully, when I go into this property, I look at it, I try to make the best decision. Like I own so many property, but I never move in to one, I would say, because I never need that kind of space, and whoever invests, I don't really want to live there.
Yeah, I've done that for a real long time. Like I never owned the place I lived in. I always I owned rentals.
Yeah, and there's more flexibility on the mortgage side and all that. So, but this is the first time we're like, you know what, we're gonna plunge in some money. Might not make the most investment sense, but it's really for the lifestyle and for a more important thing. A lot of people keep looking at the money and then they sacrifice a lot. I know deferred gratification is a big thing, but I'm now like, okay, Claudia's on the line. We work so hard for this. This is the time that we actually treat ourselves nicely and we work harder, not harder, but work smarter and really enjoy it because we're only young once and we don't do reckless things. But this is the property that don't make the most sense in terms of number, but to give us the lifestyle, give us the option if we're going to move in.
Yeah. Well, if we're being honest about Ontario in general, does anything really make sense? Like, I mean, can you really, there's some exceptions, like, and when I say it's an exception, it's like it might break even or make $100 a month. But with the interest rates where they are, the property prices where they are, like, are you seeing deals that are even worth looking at in Ontario? And I'm not saying they don't exist. There's always a deal, but in general, what are your thoughts?
I would say, I'm not the best person to say that, but we are starting to look at a lot of off-market deals because, just for more selfish reasons that in-laws in Oakville, we start looking at some of the off-market deals. So if we have any in Burlington, Oakville, send it my way because we're maybe just going to buy one.
Like as a home.
But in the meantime, we look at it as an investment property because we already have a principal residence.
In Bowmanville.
We're going to see how it goes, and it's just a tax switching thing, right? It's still 50 kilometers away. We can still use that principal residence exemption. But there are always deals, but just that with the high interest rate, It really depends on what you're going to do. Are you going to flip it? More risk? Are you going to try to buy it now for cash flow? Hey, first you make sure you can qualify for it, because
yeah, things are changing. And this is where I think like the biggest angle that still exists is getting that 5+ unit CMHC MLI Select. If you can get up to the 50-year amortization, you can start really making it more of an interest only loan. It's not completely, but it helps get that debt service down, which should help you be into the deal for less and still potentially have a cash flowing opportunity. I think that those deals are still like, I have another show, REI Hot Seat, and Jake brings those on here and we talk about them. Even with the high interest rates, you can still find a way to, it's usually paired with a creative strategy. How are you going to do it? Are you going to turn over units? Are you going to convert this unit? And that can still be done. It's just a question, like, and I think a lot of people, and I've seen a pretty big exodus from Ontario in general, whether it be going east or west or going south into the States. I've seen all of the above, but there are still some people who are just diehard Ontario, and it's going to be Ontario. This is where they invest. And that's cool too. It's just, it's going to be a bit harder in general. It doesn't mean you can't find great deals.
I think like what I really want to kind of add on to that is people got to understand the purpose of that investment. Are they really trying to rely on the cash flow? Because like I introduced this concept called fast money, medium money, and slow money.
I talk about the exact same. I call it short money, medium money, long money.
There we go. Just bump on that. And the fast money could be from flipping or from you building. Or, unless you're
your active business.
Businesses that pay you every week, once every 2 weeks. And you can have a wholesaling or like a coaching program, all that stuff. Or you have different things that pay you on a regular basis, on retainer, all that. Once you have that figured out, the second part, the medium money, is maybe a BRRRR, right? You buy
a year out or something.
Fixer upper. It might take longer time, might take more money. And then the last one is the buy and hold. It might not work now, but I'm buying it for 20, 30 years. If I have to dump money,
if you got the patience for that.
So but you got to know where you're doing, and then like my sentence strategy for the stock option fits into the fast money. That's why a lot of real estate investors are using. That's why Wealth Genius asked me to talk to her, because a lot of people don't have a way of making fast money, or don't have the time or the flexibility to do wholesaling.
But a lot of people I know like some of my coaching students and stuff, they want to quit their jobs. Like, I just want to get out of my job right away. I'm like, well, your job might be an asset for you in the short run until you figure out how to be an entrepreneur, because that's not to be taken lightheartedly. Like,
it took me 4 years.
Being an entrepreneur is mentally one of the hardest things you could do. Like the security of a job, and it's actually a false sense of security because they could just take it away from you. You could be fired, laid off, that's actually the most risky thing you could do. But going out and having to be responsible for your own schedule, your own initiatives, you can make as much or as little business as you want, make as many or as few calls as you want. Like that can, for a lot of people, break them. And it almost broke me early on. Like I just, I didn't have the discipline. It wasn't until I really hit my stride with the active like construction side of things where I'm like, okay, I got the short thing sort of figured out a bit better now. But holding myself to a high standard of productivity all the time is always the challenge. Because no one's forcing me. It's like no one's checking the clock. Hey, did Andrew get into the office by 9 a.m.?
But what's really like motivating me and keeping me on track is that I always think about how many people I need to pay per month. They're my priorities.
That's interesting. I don't think of it that way. I think of that more as like, holy crap, like like on our camp for 2 weeks, I made a payment for $13,000 and change. For payroll. And
my payroll is bigger than that, but
But that's not the full payroll. No, so August will look like a $30,000 month just for that company alone. That's not even including my other employees for other companies.
So as a business owner, you have a different level of profit, but at the same time, different level of stress and obligation to yourself and to your employee. That could keep you going, or it could break you. And there's always going to be up and down in the business too, right? So as an owner, I think like for me, early on, like first year, I was just doing on my own, make great money. Second year, my profit margin went down a lot because I started hiring people. Hiring people with the growing pain. and the stock market shift a little bit, right? And then it started going down, so less people are interested. There was a lot of momentum. People go back to work, and then now we're like, okay, so a lot of my competitors stopped their business, all that. This is the best time. How do we, if I go into any business, it's like if I can't be the top 3, if not the top 1, I will not be in that business. I've been in my coaching business for 4 years because I believe I'm on my way to be top 1 if I'm not
in
the
your
top 1.
Are you referring to the options trading?
Yeah, option trading.
Yeah, so you do the education on that. I know we talked briefly about that last time you were on.
Yeah.
For a refresher, because no one's talked about this in a while on the show.
And there's a reason for that.
Because there was a couple of hard years there, and I think a lot of people just decided to scrap it. Like, give me the scoop. Like, how many people are still doing this? Are most of the people that were doing this like 2 years ago and before still doing the options trading?
Very, very good topic. So the reason why a lot of people got in during COVID is because you're locked up at home. We have a chunk of money. We have some free check coming in from the government. Where are we going to put this? Oh, now might be a good time. It's a high inflation. Think about investing. What's the easiest thing? We're locking at home. Let's go watch some YouTube video.
Yeah.
Let's go learn about stocks.
Yeah.
And then the stock market went up from March 2020 to really January 2022. Let's straight line up. But
so with the real estate prices, it came down. Yeah.
Yeah. Like stock market is usually about a few months ahead of real estate. So the stock market started coming down and the real estate started coming down in March, right? So that's when a lot of people in risky stuff and they just know enough to be dangerous. They were like in a lot of high growth stock. They got hurt a lot, right? So that's when I saw that coming, like, this is ridiculous. We need to scale back the risk, and how do we make it more consistent? Because a lot of my clients are looking for, they're already in real estate, 87% of a real estate investor, business owner. They're looking for a consistent cash flow. So we try to take away a lot of the variables that were causing the inconsistency. That is picking individual stocks. A lot of time you pick 5 stocks, 4 goes up, 1 goes down. The one that goes down offset entire profit. Yeah. Right. So taking away that a lot of time and effort that put into picking a stock, and truthfully, even Warren Buffett said it's hard to beat it. So that's why we really come back to the S&P 500.
Yeah, like indexes.
Indexes, right? And now all our selling option, like an insurance company, right? We get paid premium. That's our cash flow.
Are you selling options against the index?
Yeah, we have been doing that for the last 2 years. And first, you don't have to pick stocks, less time, less stress.
That's pretty straightforward.
And second, there's less volatility.
Yeah, I would think so.
A lot less volatility. And third is...
So are you like NASDAQ, S&P 500?
S&P 500 only. Like, we look at NASDAQ, but NASDAQ's too volatile. We're targeting to make like 1.5 to 4.5. My accounts on par to make 40. And truthfully, like, I only spend 30 minutes per week. We're not looking for the ultimate return, right? I know there's other programs that make 100% per month, 100% per year. The moment someone come on and say that, I'm like, hey, we're not a good fit. But we have to beat the index of 8 to 10%. Otherwise, it's not.
Yeah, is that what it is over the past year? Like the index itself has gone up. I'm just looking at it over the past year. It went up from just under 4,000 to 4,500-ish.
Yeah, about. Yeah. So if we don't beat the index, what's the point of even learning it and spend 30 minutes per week after you learn it? So we have to beat the index.
So you still selling puts? Is that the angle?
Yeah, we have puts, we have calls.
Covered calls if you happen to get your put called.
Our strategy, so our beginner strategy is about selling puts, getting a sign only for long term. But if it's a true fast money and set and done strategy that TD Bank keep asking me to go back to talk about it. In case you guys don't know, if you log into your TD Bank account, you might see me 25% of the time, my face there.
You're on the TD Bank login?
Yeah, like TD Direct Investing. If you log in, like, people come up to me, like, is that you? I'm like, I promise you, I cannot see your account. Okay, that's just their internal stuff. I cannot see your account. I promise. And
people are funny, man.
Yeah, it's really for the people who are looking for consistency, less time. They want to beat the index, but more consistent way. We're not looking for the...
So if the index is doing how much on average, historically, what, like 12% or 11?
8 to 10% per year for the last 30 years.
Okay, 8 to 10.
That's what Warren Buffett...
And what are your students like aiming to get?
Well, some of them they're even busier. They make about 1.2 to 1.5 per month. My account is on part
like percent. Oh, okay.
Yeah, per month. So that's about
18%.
18%.
Yeah.
Right. For them is like, hey, if I can get more than private lending, I have full control. I don't want to rent out promissory notes. I don't know where the money is going. And then, on the higher end, some of my students are making 54 because they're a little bit more interested, passionate about it. But I'm in the middle. I just want to showcase that with a 7-figure account, you can make the minimum amount of effort after you learn it, 30 minutes per week. And I'm not suggesting anything. People just see it. All my students see it. I even show on Instagram and Facebook and YouTube. I've been running that account, I think, since last September, the public account, because I pull it out. My lawyer told me, Cody, just be very careful. There's a lot of fraud. People can call into IBKR and pretend to be you. You know that
because they can see information.
I just want to be fully transparent. But at the same time, my lawyers are, you got to protect yourself. So separate that account. The maximum they can take is 25,000. So I'm like, okay, that's usually what most people start with to try it out.
So you're just growing a $25,000
so
account.
I'm going to grow it for 10 years.
So when did you start?
That one we started end of September last year.
Okay, and what's it at right now?
I'm like 35% right now.
Like 35% up. Okay.
Yeah, up. So we're almost up to 1 year, right? So that's
nice.
that's why I think like a lot.
So this is your active strategy for like living that and coaching or your short money.
Yeah. And then And
what's the typical turnaround on like a put option? Like how often are people getting paid?
And here's the part, because a lot of real estate investors like, Cody, I know about selling put on individual stock, but I got stuck for such a long time. I'm looking for the next property. Meanwhile, I need somewhere to make money. So our send strategy is actually, we don't need to own anything. We have a percentage calculated out to be 98% chance of winning. There's 2% chance we might take losses.
In other words, having to acquire the stock because your put hits a strike price.
That's why we're on S&P 500.
Yeah.
Because it's cash settle. We don't own anything. We just take profit.
Yeah.
And then every time we put in a trade, we set it as in profit taking, profit losses. The moment we put in the trade, it's already there. So you can even be without internet if you want to.
Oh, okay. So you predetermine if this happens,
we put in a bracket.
Okay.
Right. And the moment it's filled,
So when you say cash settle, like you don't even want to acquire the stock, you'll just pay out.
We're really getting the premium, just like an insurance company. We're getting the thing.
No, of course. Yeah. So that's in an ideal, you just get the insurance premium. But then if it goes the other way and it hits the strike price.
So we usually never let it hit. There's 2% chance we'll get a hit because usually we're like 10-15% away.
So you set a parameter to just just rebuy your put if
we would close it.
Close your position. Right? So then. Yeah, so that lingo, you can tell I don't actually do this stuff. So
no, that's fine.
Just
that's
looking
good.
in from the outside.
No, that's good. Yeah, we just play a probability game.
Yeah,
and we're helping people who are already really busy, have a full-time job, but they want another stream of cash flow, right? Yeah. And they don't need to know the most and pick stocks and all those crazy stuff, right? We're taking away the risks.
Yeah,
minimum amount of time and stress. And they have the ability to pull out the money, usually within 10 to 20 days. Because each of our trade, the expiration date is about 45 days. And usually we close it in 10 to 20 days. So if they need the money out, they can pull
you close them early. That's okay.
Always. So even if they're like, I need the money out, I need to pull it out. Okay, Cody, I need to take a 2% loss to take it out. Cool. If on average you make double digit per year. Okay.
You don't worry about a one loser.
Yeah.
Okay. So just walk me through like closing those positions early. So if we walk through the initial concept, it's you're selling insurance against the stock going down. In this case, it's an index of S&P. So a unit of the index, say it's trading at 45.24 right now. You're saying, if it goes down to 4,000 or what would your price be?
If it's like within 45 days, if the S&P 500 stays about 4,000, like 10 to 15% down. If it stays above that, I collect all the premium. You
collect all the premium. So is that the kind of strike price you might set, like $500 less than it's currently trading?
Yeah, about 10 to 15%
away from it.
So because the reason why we look at that is that from the stats standpoint, every 1 to 2 years, there might be about a 10 to 15% correction. It could go up or go down.
You could have a big event and all of a sudden, you're getting, you're having to buy a whole bunch of the stock. Now you might say, well, I wouldn't mind owning S&P, especially at a discount. Like it's a very diversified portfolio of stocks.
Yeah. But setting down strategies where we have to fast money. So we are intent to get paid the cash flow.
Yeah. So you're not looking to do that. So if you did have to buy the stocks, but your strategy won't even allow for that. It won't even allow for that.
We take the proceeds to go sell puts or go buy a whole or go fund your lifestyle, fund your expense.
Yeah.
Right. That was the whole premise.
Yeah. So, and just to reiterate for anyone not familiar with this, so this is basically like Cody's selling insurance. He's selling insurance against the S&P 500 going down. And what do people pay for insurance? They pay a premium. So they're paying Cody, a few $100. And Cody's betting that the S&P won't go down, so that he, for that reason, he's collecting that $300. And as long as those 45 days pass, or if you close the position early,
usually 10, 20 days.
Okay,
so say drop more than 10%.
Then you get paid. So hypothetically, if you let them pass the 45 days, and it doesn't go down to the strike price, you collect that whole premium.
Yeah,
that's your money.
Yeah.
And you didn't buy the stock. You don't even own it, or the index.
Even if you get challenged on those positions, you're not obligated to buy 100 shares of S&P 500. No, you're not obligated. It's because it's cash settle, and we have a.
So you do a cash settle. So you just do a mechanism. So you might set it up that you're selling the put for 4,000 strike price, but you have a mechanism.
We actually do a bit of spread. Like put spread just means a fancier words. We have a hedge put in.
Yeah.
So we reduce the amount of margin requirement, because if COVID happened, we want to make sure our student. Let's say if each trade costs about 5,000, each trade we are allocating 20,000, and we know the maximum amount of margin requirement. Because during COVID they do increase the margin requirement.
This is what I wanted to ask you. So what happens if you've got to buy out of your position? So you've collected a premium and now you want to close that position earlier. That means you're going to have to pay something to close it earlier.
Yeah, but you're in profit though, right? If you pay $200, you pay back 100, you still keep the 100.
Yeah. So but what if you're like right down near your strike price? Then it's going to cost you even more to buy it back. Right?
Very good question. Yeah. So usually before we hit the strike price, we already have a mechanism set in for stop loss.
So stop loss, and that can be automated,
it's based
right?
It's automated.
Yeah.
So the moment the position is filled, we put in something called a bracket order. Yeah. So we have a stop profit, we have a stop loss.
Yeah.
But if you're more like less hands off, you're more hands off, you're like, okay, just let it hit. Okay, based on probability, you're still gonna be profitable in the long term. But if you're like, Cody, I know you talk about the active management skills. Like, okay, what is that? Right? If you're more savvy, like our more advanced student, then we can actually adjust the position, and we have the brackets down here. We can adjust it from 4,000 to 3,900. We can actually get paid more to adjust it out the position. We had it 45 days, 20 days passed, we got challenged. Let's move out another 45 days. We can pay $200.
You can do that. So there's a lot of flexibility that you can do here.
And then we're really banking on there's less volatility. We're not picking individual stocks. S&P 500 is not going to go to zero. Right.
I mean, it seems like very unreasonable to think that. Yeah. And this is something where anyone can look at the S&P and see how it's performed in down times, good times, and get a general idea of what's likely. It doesn't mean you know anything for sure, but it gives an idea. The reason I bring this up is not to educate people on how to do this stuff, because I don't even know how to do it. I mean, I know in theory, but I was curious, are there real estate investors still doing this? Because it seems, so anyone who wants to learn more about this, you can go back to the old episode with Cody on it.
Old episode when we talk about selling put options on individual stocks, but we never talk about
on an index.
Our set and done strategy and why TD Bank asked me to go back 2 years in a row. And that's really
talking about that.
Talking about,
but they don't even do that. Like, you can't even use TD's app to trade puts, right?
So off the record, TD asked me to not mention while we're trading, just say S&P 500, because TD platform cannot trade S&P 500 future options. They don't have any future options. So we use interactive brokers.
Yeah, that's IBKR. So my point is that you can see the old episode with Cody. There's old episodes with Erwin. I think a few other people have been on that have talked about doing this.
But just check out my YouTube channel. It's all free. And
you have more education on that too?
I keep pumping out once per week video about it. So
yeah, it's interesting. So is your estimation then, like, just kind of ear to the ground, because I haven't been paying attention to this at all, would you say like only 20% of people who were doing this during like the lockdowns are still doing it, or even less?
Like, we continue to have we're actually limiting the amount of students we're taking, because I stay very honest with our capability of the ratio between our coaches Right now we have 3 coaches, right? We're trying to hire the 4th, all from within, but some of them are not ready.
Oh, like your own students that you just hired?
We hire them because they're trained.
They're doing it.
And we have, we can only take 5 per month and all that. But I would say a lot of people stopped doing it, maybe because they got hurt a lot. But on the flip side, a lot of people got hurt, but they know that they were doing it wrong, and they realize that, a lot of time when I talk about this, people understand why this is valuable, instead of just banking on individual stocks. It might drop, you're not getting paid any premium on cover call. People, different level of people. But if they want a fast money, I want to call it fast money, they want a consistent fast money, and they're between deals, or they want to replace a full-time income, this set and that strategy will fulfill that. But the selling options on individual stocks, I don't think it will fulfill that, because that's more mid to long term, because you can get stuck in there.
You get stuck with a stock
for a long time.
One stock on its own is more volatile than an index of stocks.
For sure.
Has to be. So that makes sense. I mean, anything you're going to invest in, you want to know, hey, what could I earn? What's my downside? How do I hedge that risk? And I like that you talked about doing stop losses, things that are built-in mechanisms. And again, this is coming from an uneducated position on this. I like the idea that there's something like that there. I would want to dig into how foolproof that is. What if I try and buy out my position and there's some sort of delay on the other end and I can't, or the automated system fails, but I'm sure you have answers to all that stuff, which we don't need to go deep in now, because it's probably a technical answer. Yeah. So, but good to know. So that's your short money. What did you do, remind me, prior to being an entrepreneur in this type of stuff?
I was an engineer. I was working for Honda.
Okay.
I was a project manager.
Okay.
I was doing all the way from problem statement to coming out with a contractor of tendering, and then interviewing the contractors and follow through the supervision to see it come through at an industrial environment.
So what type of engineering did you study?
I was a mechanical business.
Nice. That's busy. Which school do you go to?
UFT, University of Toronto.
Okay. And when did you get out of that? Like what year?
I did a 1 year, 16 months of internship. So I fully graduated 2015.
2015, and worked for a couple of years?
Yeah, I would say from 2013 to 2014, so 16 months there. And then from 2015 to 2019, Honda, and I moved to a closer company in North York, because I always want to come back to the city. I miss out a lot of those, and I drive down on the weekend. I work a lot of overtime back then. But 2019 was when I moved to mid-management in North York, and then after 6 months, I'm like, you know what?
You just went out on your own.
I have some income replaced. Most of the income is replaced. I'm like, if I'm going to do something at age 29, this is the time I got to think about it.
Yeah.
And I took a few months off, traveled to Spain, and I come back with, I'm going to start a YouTube video. I don't know how to do it. I'm going to start it. And that's when pandemic hit. And everything, I'm like, there's no difference in my life. I mean.
Yeah, I mean, from what I gather, I mean, people who talk educatedly on stocks and what they're doing get views on YouTube, and highly monetizable views too. Both from a YouTube advertising standpoint.
Not as much
from that, but way more from direct monetization. Yeah. Like you selling stuff, like the piddly amount that YouTube gives me. This is why I never did it for like all these years.
There's months I get paid $3,000. Don't get me
wrong. Really?
Oh,
see, I don't get anywhere near that.
Yeah, my CPN at one time was over 100.
Cost per
million views. Every 1,000 views, they pay me $100. Just one time.
Oh, okay, yeah.
But anyway,
cost per mil, the Roman mil, 1,000. Yeah, yeah.
Yes.
That's what CPM means, I think.
Yeah, cost per million. Yeah.
Per mil, not million, mil, MIL.
Yeah.
Which is 1,000. Yeah.
Yeah. Sorry.
Yeah. So like the floor thickness, when they say it's like 6 mil, I'm like 6 millimeter. It doesn't look 6 mil. No, that's six 1,000ths. Yes, 6 1,000ths.
That tie.
Yeah.
Thou. Yeah.
Yeah. There you go. So what's the? So that's the short money, and it seems like it's been going well for you. Obviously, there's stuff that people don't share. Precisely, no one likes talking about their losses or the challenging times. I'm not saying that you're guilty of that.
No,
I
put it up on my YouTube channel.
You share. Okay,
there's an account that have some Palantir. I have some Neo, like those electric car company. But I share the losses, but I share the lessons from that and what people can do if they're there.
Yeah.
just like growth stock.
It's important to talk about losses.
Portfolio.
Yeah.
Like the less weight in your portfolio, right? So I share all that. I'm like, most people don't share those. I gotta share those, right?
Yeah.
And whatever.
You gotta share when you lose. When you lose, you share about it because. And I'm pretty transparent. I'll run through the deals on the stuff I'm doing, and it's like, hey, that wasn't a great one. You know, it was okay, but it wasn't great. And I've had I started out losing, so I've talked about that millions of times on this podcast.
And you build more credibility, and you're real, right? Yeah. You're real, and people learn more from those.
Hey, if you play the game, you can get burned. And it's what you do when you get burned. Yeah. How do you respond? And you could do what I did when I first got burned in real estate. And I tucked my tail between my legs and got out of it for a year and a half. And then I'm like, wait, what am I doing? I'm watching my friends and my mother-in-law crush it, make hundreds and hundreds, millions of dollars. And I'm just like, why am I on the sidelines? And it took me a while, but I got back in. I think that'll happen for a lot of people who've, even done this. If this was a thing for them, if they were enjoying it and they were doing well, they made a mistake and it was costly. Is it something you can recover from? Yeah,
it takes time. Although, of course, the number one rule is not lose money. But hey, we're in this investing game, entrepreneur game. We're here to figure out, I don't want to say we fall forward, but just start smaller so that even if you fall, you can get back up, right? And then just learn from there and learn from people already ahead of you. And that's why, I have friends are younger than me, friends are similar age, friends are a lot older than me. Like my godfather, that's what I call my rich dad, doing a lot of flips down in Orlando. Not on any social media. He flipped about 30 houses for the last 10 years. He never borrowed money. It's all cash.
All cash. Oh, I like that. That's great.
And now it's all slow. And he's like, Cody, slow is good. Slow is good. And I learned a lot from him. He's very street smart. He's like, when he's doing flipping, he's down to per toilet cost. Toilet, $150. Window, $200. He's down to that. So he's itemize everything.
We got a little friend here in the studio, huh?
Yeah, we track a lot of these.
Yeah, all right. Fly buzzing around for those who can't see the video. Anyways, I think this is a first. I've never had this. But anyways, that's interesting. You got a rich dad. How'd you meet this guy?
Golf. So about a few years ago, I started getting into golf and tennis on a more serious level. Because that's what I found a lot of old money is. A lot of new money is. It's very true, yeah. And also, it's a game I can play until I'm 80. I don't have to get into contact sport because I was playing basketball growing up, but I get a lot of injuries. Yeah. When I walk, my knee hurts. And when I stop playing those, my knee don't hurt as much. Yeah. So I want to get into a sport that meet great people. Yeah. And we have great talk.
Golf's
and
a
I
great
can
one
play
for
until
that.
I'm 80 years old.
I really like golf for that. I've seen some, and it's the country clubs. You got to join the golf and country clubs. And I haven't done that yet because I really didn't locationally know where I would be. And right now it would be pointless because I play 3 times a year. Yeah. With the little one. Don't mind me. Hey, this will make the YouTube version of this real interesting. The fly's back. Yeah, so it's to the point I see in Naples with the community we stay in, that's a private golf course. It's 2 sets of, I believe it's 27 holes in total actually. And it looks beautiful. I've never golfed it, but the Ferraris I see there, I mean, just the wealth I can see there, you can just only imagine the opportunities that would come up. The people you would meet, the lessons you would learn, the potential partners you would find for monstrous deals. Yeah. Because these are people who are probably busy doing their own thing, and they're there to meet people like you potentially who do things. Yeah. And I know that's an investment. I think they said it was $35,000 to buy in. That's not even that much. It's worse around here. If the Hamilton one's
the one I'm looking at nearby my house is $100K to buy in.
Yeah, to buy in. Yeah.
Yeah.
And then you got your annual fees on top of that.
Yeah, it's not cheap. If you just won tennis, $30K, but won golf, $100K. But it's such a nice one, and I get to know
and who you meet.
I get to know their captain, and he's going to invite me back in September to play.
You got to break it down into how many deals would I need to do to pay for that, to justify that, and you got to be mentally ready for that if you're going to do it.
And I'm thinking a lot of these marketing I'm doing, because I have a podcast as well. Andrew, you've been on. Now we're all in person. We're filming in Bowmanville. Right. So you're going to come back. I
forgot about that.
You're going to come back on again. We have a filming day coming up. But a lot of these marketing things, a lot of these joining the club, playing the tennis, I don't go out and say I need that money back right away, because I'm going out as a wrong intention. I'm truly going out and make connections. if I can help people, right? A lot of people older than me, but I can help in my own ways because I know technology a lot better. I can refer them and all that. So if you have the right mindset go in there, you will meet great friends. No, I'm not like going in, I'm asking for money. Like people see it through.
No. You want the people who are, think about your top 5, like the top 5 influences in terms of people. Who are they? And what are they? You know, are they people you went to high school with, or are they people who are above your level that are kind enough to let you hang out with them and they pull you up?
Yeah. And I love like my godfather, and then we're going on an Asian trip for 3 weeks in October playing golf. They're all like 50, 60, like builders. They supply windows to builders, countertop. They supply all kinds of stuff, right? And they're like, Cody, I really want to help you the next generation. And those are the people that will give everything to you. Because if you have the same kind of like friends around the same age, competitor, non-competitor, a lot of them has a little bit more ego, right? They don't want to share a lot of it. But people are ahead of you like, Cody, man, I'm just counting my days on earth. So learn all this. These are all my lost lessons. Yeah, man. Learn it.
I'd be so interested if you want to set up a round of golf with one of these guys. Get the Godfather back here.
We play every week, and then we have like, you know, we have a part of a different golf club. I'll invite you on that. I won't be the September one, but October I'll invite you. I'll introduce you to all of them.
Yeah, give me a good heads up on that because I got to plan these. I got to get permission.
October, we'll talk offline.
We'll talk. You know, we won't record that part. Anyway, so in a very short and concise way, like, what do you see as being the next 5 years for like sort of the long money for you?
That's a great question. So, for the next 5 years, this is the way I look at this. I know Alex Hormozi talk a lot about focus. I have other opportunities, and I truly think if I want to stay as the top one, if not only the top 3 in the stock option investing world, I need to like build up the whole team because we are like launching a hedge fund. I know last time we talked about it, but I'm really waiting for a market to kind of be very volatile to test through it, and right after that we're going to set up a hedge fund to prove that this is what our account went through, how we come back and all that. That's our long-term goal for sure. But in the midterm is like scaling up the coaching business to help more people because we have a lot of referral to have a good quality. Scale up to at least 3 mil per year gross. And then that's when I will start pivoting. And you know, now that Claudette, my fiance, wants to get into Airbnb arbitrage, and I will help her with my knowledge and her knowledge. I'll help her scale that to 1 million. And I think at that point, we don't have to worry anything about the fast money. So now we're going to take those proceeds, like, where do we dump it? Some private equity, some back into the marketing, some to buy a whole real estate, or some
I think long-term development deals too. Like you could do stuff that's where I think like long money. I'm thinking like long-term storage development, other things like that, which it actually doesn't even need to be that long. Couple of years, 2 to 5 years.
I know Nick and yourself talking.
Nick's doing it very aggressively. He's it's very smart because to me I've always neglected the fast money a little bit, or the short money, because I was more excited about the long stuff, like what's going to build that long-term wealth. But you need all of them firing.
You need all of them because here's a story I'm going to share before I go. But some of you guys know a really top 10 wholesaler in Canada. I'm not going to mention the name, but if you guys go to Wealth Buster, my podcast, he share everything. So I'm only going to share the numbers. When the market turned, he has 18 flips on a go. He has $10 million hard money at 10%. And his partner fled. So the moment he knows, because his bank called him and said, where's your partner? You're not paying. He has to make a decision that should he go bankrupt? Should he go run out of the country? Should he go suicide? Or is he going to ramp up the active business to make at least $100K per month to fill that hole? And thank God he made that decision to double down wholesale. He was going out to do what he has a team of 5, but he going out to just knock on doors and doing what he was doing.
It's amazing what people can do when they're pushed.
And then he now is 8 months in, and he was like offloading half of it. He still have half to go, but he's like, Cody, I can finally breathe. But I'm so happy that went through, but it was a humbling experience.
Very interesting.
So anyway,
cool.
You probably know the person. And
I probably would.
On the podcast
I'll have to look into that. Cody, where do people reach you?
Just Cody Yeh. Type in Google. Type in YouTube. Instagram. You can't I can't hide. It's
Okay. Yeah, I'll throw your Instagram handle and your YouTube in there. And yeah. Okay. Perfect. That'll be in the show notes. Thanks for doing this.
Yeah. Thanks for having me.
Yeah. Let's go eat some food.
Let's do it.
Okay. All right. Thanks, Cody. There are a lot of people out there talking about the infinite banking strategy and whether or not it makes sense for them. To find out what it's all about and if it's a fit for you, visit controlandcompound.com/Andrew Hines, where my audience can gain exclusive access to books, podcasts, and webinars tailor-made for real estate investors.